Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today. Have you noticed the TSX is up like there is no tomorrow this year again? And actually, kind of interesting because it beats the S&P 500 in 2025. One of the reason is actually because the TSX is driven by gold. We own most of the major players in gold mining stocks in North America. Most of them are actually trading on the Canadian market, which is great. And right now, they are on fire. We're talking about triple-digit returns for a lot of them. So what drives this interest toward gold? I mean, yes, gold is a store of value. It's a great refuge if you think that the market's going to crash. So that could be a possible thesis, but there's a little bit more to that story. And that little bit more is the debasement trade. Debasement trade, what is that, right? So the debasement trade is a defensive long-term investment strategy when you expect that the fiat currency is going to go down, it's going to be devalued, right? And you want to find a way to protect yourself against this. So today, in today's market, we see that governments are running with high deficit. They have a problem between either raising taxes or cutting on spending. And especially if you're living in Canada, I mean, there's a limit of how much taxes they can raise, right? So it's either like we're going to keep on spending to stimulate the economy and we're going to keep on borrowing more money and then issuing more money, and then while you devalue the value of that currency at the same time, or we're going to cut on spending and then probably hurt the economy even more. So you can imagine that this is a very bad problem to have at this point, and a lot of investors are thinking, well, I might want to protect myself with gold. So the core drivers metrics right now that helps moving the debasement trade even faster. Well, you have the debt to the GDP ratio that keeps on going up across the G7 nation. I have to remind you that in Canada, we were the first country in the GDP 7 to cut down the rates, trying to stimulate the economy. So we are already like in that problem as well. There's of course, monetary expansion. So if you look at how much currency is being issued with quantitative easing, also known QE, buyback bonds, for example, that happened in 2008 and then in 2020. So the financial crisis and the COVID forces central banks to fuel the market with more money, buying back bonds and improving the liquidity. But by doing this again, the value of the currency will go lower. And finally, there's a lot of investors who are thinking, well, those governments, they don't know what they are doing. They're just on that printing machine, like going crazy. And that includes a loss of credibility. So three major drivers that are, I mean, you cannot ignore them. It's not just a narrative. Those are facts. Those are things that are going on right now. And then why gold is being seen as such a great place, a great store of value. Well, if you look back in time, which is fascinating, but if you look at what you could have bought with an ounce of gold 3,000 years ago, it's pretty much the same thing as what you can buy today. So the value of gold have tracked inflation pretty much always. Sometimes it's going a little bit better, sometimes a little bit under, but overall, for a very long period of time, it is a perfect store of value. So while you may have doubts about your 20 bucks in your pocket, if you have gold, you will never have doubt that it will keep its value. And that also explains why the ounce of gold has crossed the psychological mark of $4,000 US. Actually, it's even more now. So it keeps on getting more traction. It sees more traction because central banks are actually buying more gold, and then investors are buying more gold, and then institutional investors as well. So everyone wants to make sure that they're protected, and this is what pushes gold a little bit higher up. And then if you buy gold mining stocks, well, you're making a lot of money. And again, those are not financial advice. As you know, I'm not a big fan of the yellow metal, and I'm not really into gold mining stocks, and I'm going to explain you why. So first, if I look at gold, No denial here. It is a store of value. It's going to keep track of your purchasing power. And if this is the reason why you want to have gold in your portfolio, that's totally fine because it's a line and it's a fact. On the other side around, though, that yellow metal doesn't sell anything, it doesn't produce cash flows, and it doesn't pay dividends. So I'm not super interested in having an asset that is just sitting there on my desk and doing nothing for decades. I prefer to buy operating companies generating cash flow. Again, that's just me. That's just my strategy, but that's my perception. The other thing is, oh, but Mike, you could buy gold mining stocks, right? That totally makes sense. They are operating companies. They are generating cash flows, and some of them are also paying a dividend, which is even better. The thing here, though, is a lot of them will not only pay a dividend, but also increase it when the gold price goes up like right now. But let's be honest, they have absolutely no control over the commodity price. So when it goes up and it goes down, they have to suffer the consequences. So they ride the wave and then they die with the wave, and it's pretty much always the same. In 2020, 2021, there was another gold rush. People went crazy and it was just like, wow, they are increasing their dividend by 50%. That's amazing. Well, first, 50% increase are not sustainable. I mean, in case you haven't noticed. And the second thing is, most of them, they just brought back their dividend to the previous level that they had before cutting it when the gold price was lower. And it's, again, probably what's going to happen moving forward. Not necessarily in 2026, because maybe the debasement trade will last for a long while. But keep in mind that if the commodity price doesn't keep going up, well, those companies will see their fees increasing. They will have to buy new assets. They have to do more digging. They have to do more exploration. And that requires a lot of cash flow. So, of course, there are well-run gold mining stocks. But when you look at them, they are on a roller coaster ride. It goes up, it goes down, it increases their dividend, it decreases their dividend. So this is not the type of investment I like. But I have to tell you, those that I believed in buying gold or gold mining stocks a year ago, 2 years ago, I mean, they're making a killer right now on the stock market. And the reason why is because of that debasement trade. So now moving forward, what should you do? Well, what you should do is really think about your investment strategy and about the asset allocation that you want. If you want to have gold in your portfolio for the reasons that I explained earlier in this show, that's totally fine. But you should not rush into gold because now it's trading above $4,000 an ounce, or because those companies have generated more than triple-digit returns over the past 12 months. It's great, but then you're running after past data, and it doesn't necessarily tell you that it's going to happen again in 26 or in 27, right? So you should add gold to your portfolio if you believe that you should allocate 5, 10, 20%, whatever the percentage is, into this type of asset, or into this sector if you prefer to buy operating companies as I do. So thinking about that and then moving forward, it should always be about the same percentage of your portfolio that is allocated to this section for the same reason, regardless if it's gold going well or if it's not going well. Because from time to time, you will see, if you follow the gold price, it's not always going up, pretty much as anything else. So it's really important to define how you want to manage your portfolio first, and then you can trade. And it's a lot easier this way. So you need investment rules to do that. To help you get those investment rules right in order, I provide you with a complete example of how I set up my investment rules so you can look at them, get inspired by them, and you can tweak them as well. All you have to do is to register to my free newsletter to get them, and you can do that at thedividendguyblog.com/newsletter. So at thedividendguyblog.com/newsletter, you will subscribe to the free newsletter, and then we are going to go into a journey about how to buy your buying investment rules. It's going to help you make decisions, and you don't have this FOMO, this fear of missing out. Say, oh, should I go into gold? Should I sell gold? Now Bitcoin is going down. Maybe I should go to that digital gold instead. Well, all of those answers should be easy to answer. All of those questions should be easy to answer if you have a clear investment process. So, right, Moose, that's enough for today. Tomorrow, we are talking about banks. So we're going to have a complete video on Thursday around maybe 10 or 11, because some banks are reporting on Thursday morning. So I'm going to do a video on YouTube going through all the big six banks plus a few more surprises. And tomorrow morning on the Moose on the Loose, we're going to talk about bank.to. So should you sell your banks and then buy this ETF instead? We're going to do a deep dive. All right, Moose, that's enough for today. We're going to talk again tomorrow. Until then, don't forget to stay invested.